Now, from WNYT, this is Forum 13.
Good morning, I'm Phil Bailey. Thanks for joining us on Forum 13. We'll be talking about some tax tips, and then we're going to talk with a group who's been working on the down low with people in the capital region for years. But first, let's turn our attention to the tax deadline because it's looming. We're joined by Kevin McCoy and Kevin O'Leary, both CPAs and directors at Marvin and Company. Thank you both very much.
Thank you. Thanks for joining us.
All right. First of all, the tax deadline is traditionally the 15th. That's not true this year?
Yeah, we have a couple circumstances this year with the holidays that extends it a couple days. Usually it is fixed on the 15th, but with weekends and then a holiday on Monday, we have a couple extra days this year to get your returns in and still be timely.
So the deadline is when?
Well, 18th, 19th, depending on where you are actually in the country. But for the most part, the 18th is what we're looking at.
Okay, so let's say the 18th so nobody misses that. If you can't make the deadline, you can file for extensions, right?
Yep, you can file for extension. The money is always due on the 15th or the 18th this year. And we always recommend people estimate high because if you owe taxes when you finally file, there could be some interest involved. So always estimate on the high side and get your money in on the 15th, and then you have until October 15th to file your final return.
And this is important for neophytes. It's not like you can just miss the deadline and go, I'll do the extension thing. You've got to still file something, right?
Right.
And in most cases, pay something?
Yes, well, if you owe, yes. And you really have to do the bulk of your return to figure out how much you should pay. So you really have to have a lot of your information in place and a lot of your records in place and trying to figure out an estimated tax number that makes sense to go in on April 15th.
Any reason to file an extension? If I'm going to get $800 back, any reason to file an extension?
Oh, yeah, you still should file an extension because technically your return is due. The government's looking for it. If you're certain you're going to get money back, then people don't file, but you should file. That's really the law.
Give them a piece of paper.
That's correct.
Because otherwise you're going to pay a penalty, right?
Well, you could pay a penalty for failure to file timely if you don't have an extension in. Yes.
Yeah. All right. There are deductions. We were just talking about this. There are some deductions that people commonly overlook. They could be getting money back or save money, and they just don't know to file them.
Most of it has to do with credits, and deductions are part of that once you determine your income. A lot of people who think, well, I only make $10,000 and I have a child, so I don't have to pay any tax, even if maybe they didn't have any withholding, so they figure there's no reason to file because there's nothing to get back. I had a circumstance this year, actually, where a single mom, $10,000 worth of income, she got back $4,400 in credits that she didn't pay in more than $167. So a lot of reasons to file.
Right. So look into these. It's a great example. And you can even go back a few years, right? If you didn't take these credits and now you learned about them, you can go back a few years, right, and get even more money.
Yep, the statute's 3 years. So there's always that opportunity to go back. But it's a challenging thing to amend returns. It's not the easiest things in the world if you have already filed and you maybe forgot some things. But yeah, the statute is 3 years. You can go back.
Yeah, but it is possible, like your example, this woman who got $4,400, and if she goes back 3 years, so she might, if the same circumstances exist each year, she could get $12,000.
Potentially, yeah.
And that does happen, right?
It does happen.
And they'll pay interest, too.
Okay. Wow. Now, some deductions that I think, some of the common deductions people don't know if they can do or not. Like, if I buy a pair of blue jeans and I wear them to work most of the time, can I claim that as a tax deduction, a business deduction?
No. Clothing, if it's general use clothing, it's not a tax deduction regardless of what your business is. Now, if you are in a construction trade, for example, and you have to buy heavy-duty boots to protect your feet that are not boots that you would typically wear, then that would be the type of deductions allowable. Uniforms, special clothing, protective clothing, that would all be a deduction. But suits, because you're on the air and you want to look good, no. Sorry.
So if I buy a shirt that says Phil and Sunoco, assuming I work for Sunoco, is that deductible?
That's kind of on the edge. If you probably only wear it when you're working and it's a requirement that you wear it, then the answer would be yes.
But don't fool around with that, right?
Don't wear it on the golf course because it's a golf shirt, in other words.
All right, so what if you do some of your work at home in your office or den at home, can you take a deduction on that home office?
It has to be, I think the thing that a lot of people overlook is the exclusiveness of the room. The room has to really be exclusively used for business. So if you move the things off the counter of your, your kitchen or your dining room table and you start working there at night, that's not used exclusively for business. So if you can pass that test, there is a possibility that you could use that as your home office deduction. And then you kind of figure out the square footage of that room versus your entire house. If it comes out to be 10%, you might be able to take some of those deductions that normally would not be included as normal deductions that you'd be able to take. So there is a possibility, but it can get a little tricky.
Someone told me once that whether you have a door going into this room makes a difference.
Well, it has to be a separate and distinct area, and it has to be solely and exclusively, as Kevin said, used for business. So a door certainly makes it evidence. I don't know that there's anywhere in the regulations I've ever seen that it's required to have a door.
All right, what if you check your emails, your work emails, respond to some of them, compose some ideas, or a report on your computer at home? Can you claim it as a business expense?
Computers are what's called listed property under the law. And what listed property is, it's anything that is a combination of business and personal. Your car, for example, if you drive around. Used to be cell phones until recently they just said, forget about cell phones. We're just going to let you take them as a business expense if you use it for business. But computers are still considered listed property. So you really have to, you're supposed to keep a log and actually say that 50% of the time or 60% of the time I use my computer for business, therefore 60% of the cost of that computer would be deductible.
Okay. All right, how about tax credits for education and college education?
In the legislation that was just passed in late 2010, there was two major education credits, the Lifetime Learning Credit and the HOPE Credit. The HOPE Credit was replaced with the American Opportunity Credit. And basically, for your first 4 years of undergrad, college tuition, some expenses that relate to books, things of that nature, you can use that if your income is low enough to maybe get some credits that can actually be refundable to a certain extent. So any money that's out of pocket, if you have scholarships, grants, things like that, you can't use that towards the credit. But any money that comes out of pocket, you may be eligible to take these credits.
All right. How about tax credits or deductions to encourage people to buy a house now when they're trying to get this housing market going again?
Well, the homeowner credit, unfortunately, isn't still in place. It was a good credit when it was in. There's a couple home-related credits. The one that I'm also seeing people missing a lot is the energy credit, residential energy for last year, where if you did insulation, doors, windows, people don't even think about what they did until somebody asks them or a checklist pops up on your computer. But you're allowed a credit up to $1,500 if you put a new storm door in, or new door, new windows, new insulation. So there are some credits still out there. And plus, you can always deduct your mortgage insurance or mortgage interest, as well as a new provision allowing you to deduct mortgage insurance as well.
Really? All right. Is that new, the mortgage insurance?
Mortgage insurance came in, a year and a half ago,
yeah, it might
2
be
years
the second
ago.
Year.
That it has to be a certain type, qualified, principal residence, and if you have to pay mortgage insurance for a period of time, you get a deduction for some of it.
All right. This may pertain to older viewers, doesn't have to. Want to give a sizable gift, maybe to their kids, and don't want to lose it to the gift tax. There is a limit. There's an amount of money right up to a limit that you can give without paying the gift tax.
Yep. And there are some depends that go with it, I guess I would say, but on a normal basis, if you give less than $13,000, you do not have to file a gift tax return. The gift is not deductible. We get that question a lot, and it's therefore not income to the recipient as well. But if you're a married joint couple and you give the money out of the same account, it's a $26,000 threshold. So anything over and above that, you would have to file a gift tax return.
Okay. You don't have to pay a gift tax if you give it to your spouse,
No,
correct?
the spouse gifts are unlimited.
Okay.
And in fact, you can give $13,000 to as many people as you want. You could give it to 100 people if you wanted, and not even have to file a gift tax
Different
return.
people.
Right. Different people.
Yeah.
Right. It's once it
Not
exceeds
14 to 1.
Right. Once it exceeds the $13,000, then there's only a filing requirement.
Right.
The gift tax is still up to $5 million, $1 million for the most part, but $5 million before you even have to pay any gift tax.
To
the government at all.
But I mean, the $5 million to who? I can't. We just established I can't give it to my kids.
Sure, you could.
If I had $5 million,
You could. Yeah, you could. You could give $5 million, and under the new law that was just passed last year, it was $5 million was the lifetime estate and trust.
Oh, there's lifetime.
Lifetime.
But only 13 at a time.
No, 13,000 annual.
Yeah.
No filing. Above 13,000, you have to file.
Yeah.
But there's a $5 million exclusion for someone's lifetime
From paying taxes.
from paying taxes on that gift. Yes. That's new. That's why.
Okay. Charities, you don't have to. There's no limit on charities.
There's no limit on what you can give to charities.
Right.
There's a limit on what you can deduct on your tax return in any 1 year. And that limit is pretty much, if it's cash, 50% of your income is deductible. But you have to be careful. Different types of contributions are subject to different rules. So you want to be careful with that.
How do you feel about tax refund anticipation loans?
Not the biggest fan of them, I would say.
I hear that a lot. How come?
I think that I think they're somewhat preying on the opportunity that's out there. I mean, if you e-file and you set up for direct deposit, the turnaround time is actually pretty good. I would say it's within a couple weeks. Maybe it tends to get a little slower as we get closer to the 15th because of the mass amount of returns that get filed at the same time. But if you're one of these people that are able to file earlier in the year, I would just say to do it on your own if you can, if you're qualified enough, or to not use that type of program because you probably get your money in a couple weeks.
And all of your money.
And all of your money.
Instead of, if you take out one of these tax refund anticipation loans, you're giving the loaner some of your money.
Yeah, right up front, you're paying a fee.
Yeah.
And if you look at the cost of that, effectively, the interest rate can be phenomenal on that. Just for the fact that they charge a fee to file it and a fee for the anticipation of the receipt. And like Kevin said, most times, if you file in the middle of February, you're going to have your refund in your account within a couple weeks if you have automatic deposit.
I don't know if it's the growing use of computers or telemarketing. It seems like there's a growing concern about scams preying on tax filers.
Yeah. It's becoming more and more apparent. The IRS does not send emails. They don't. And we've seen emails. Clients have sent us example emails that they've received, and they look phenomenal. I mean, the letterhead looks great. The letter is very authentic, but they won't send you emails. They'll send you a letter, unfortunately. And it's very hard for people to sit there and they get so nervous when they see something from the IRS. Oh, I only owe them $100. That's what the email says. I'll just send it in.
You owe us $100.
Right.
It's the IRS. Send us $100, and we won't cause any trouble.
Not a big fee because they don't want somebody to make a stir about it, so it's a little amount. Send us your account information. We have a refund available for you, which is even worse because people are excited to get money back. They will not send you an email.
All right.
And they rarely phone call you also.
Right.
Really?
I mean, before you get a phone call from the IRS, you've received several notices telling you owe something.
In the mail.
In the mail. You will rarely get a phone call from the IRS without previously receiving mail.
We've had a rough winter weather-wise. A number of roofs collapsed. A number of homes are emerging this spring needing repair. Are there tax deductions? Are there things they can take advantage of tax-wise to help them afford these repairs?
It depends on the type of property it is. If it's business property that you own, an office building, of course, that's fully deductible against the income you produce from that property, or if you're using it as your business, it's deductible. If it's rental property, a two-family home you own, for example, that would also be deductible. Personal residences are subject to what's called the casualty loss rules. And under the casualty loss rules, the cost that you incur out of pocket after your insurance coverage is only deductible if it exceeds 10% of your adjusted income. So not a lot of people get a huge advantage from casualty losses, unfortunately.
Okay. Farmers, though, apparently can?
Well, farmers are in business.
Exactly.
So just like any other business person, if their barn falls down and they were using it, then they can certainly get the repairs paid for, or deductible. Yep.
Are there tax credits? There are there not, for going green?
There are, and some of the ones that Kevin touched on earlier with regards to the solar type energy house credits are available. But there are also, for some businesses out there, there are also some tax credits that are available for geothermal and solar energy and things of that nature. They're still very new, obviously, so a lot of people are unaware of them, or they're very hard to calculate, so I would really get someone involved who has dealt with them before if you're in the business side of things.
Did I read there are some green tax credits already being phased out? I think one I read about was the Toyota Prius.
Yeah.
Each vehicle, what happens is the manufacturers come to the IRS, I guess the IRS, and they say this is the number of vehicles we're going to produce, and those vehicles become then qualified for a tax credit. Once they sell more than those vehicles, your vehicle might be on that list and not be qualified, even not be allowed a credit because they sold more than they thought.
Right. So, and that's the story of the Prius, because they're selling well.
Right, exactly.
A lot of people lost their jobs or had their hours reduced. Any advice for them? Is there any tax advantage to take out of this?
Well, I would say to Kevin's kind of story earlier is that even if you had a low income year, even if you think, hey, I've only got a couple $100 withheld, you should really go through the process of filing, especially if you have children. They're a major component of the earned income credit, which is available, and it's probably one of the bigger credits out there that a lot of people don't take advantage of. You always hear the stories at the end of tax season, how many people could have taken it but didn't. So I would say really go through the process, and there might be some more money there available for you.
All right. Websites, free help that people can look into, take a look at?
There's a lot of free filing websites. Be cautious about where you go. Actually, through the IRS.gov, a lot of people are just afraid of the IRS.
Right. Don't even want their name on the right. They're just afraid. Now they'll know I'm out there.
I've been working with them for over 35 years, and the IRS is, there, and it's part of the process. And you go out to their website, and there's a lot of great information. There's free filing forms out there that you can use. I would go there first and try it. And there's other types of websites that are available as well, free file. The state can link you to another website. But go through a reputable website to start with before you start free filing.
Yeah.
Yes,
right.
very
For the
careful.
IRS sounds like a really good tip.
Yes.
All right, Kevin McCoy, Kevin O'Leary, thanks very much for joining us from Marvin and Company.
Thanks for having us.
Good tax advice.
Thank you.
All right, thank you for joining us on Forum 13. We'll be right back.